Okay, welcome back for part 2 of Tax Foundation University Tax Reform. I want to ask before we get started, I don't want to preach too much to the choir. How many of you have had at least one course in economics in your life? Okay, this should be very painless then. Today I want to review the trade-offs in tax reform that we discussed briefly last week, and then introduce 3 new concepts that will carry us all through the rest of the tax reform estimation and design work in the next 4 weeks. There will be a few graphs, which obviously you can read. Sorry about that, but this will complete 95% of the economics of taxation theory for the course, and the rest will be the fun stuff that lets you change the world with the stroke of the legislative pen. It's a little chilly in here. Comedy clubs usually keep it cool because people tend to laugh more when it's cold. And if you can find all the pictures of Waldo in the slide charts, you can take an extra Chick-fil-A back to the office with you. So let's get started. Just a quick review. Last week we mentioned that there's a kind of a trade-off situation when you're trying to design a new tax system. You, of course, have your revenue concerns. You have distributionally neutral goals in some cases, and you certainly have a pro-growth concept going on over here. Some of these things appear to be, well, you can't have them all at once, at least not under certain circumstances. For example, if you want it to be revenue neutral and distributionally neutral, there are things it's harder to do measured on a static basis to promote growth, because some of the things you need to do to promote growth involve lower taxes on capital, which tends to alter your distribution. Now, that's particularly true when you're dealing with the static estimates. If the growth actually occurs, the interaction between distributional neutrality and revenue neutrality and growth get changed a bit, because if you actually succeed in generating the growth, you get at least some of your money back. And as it happens, when you raise the growth rate and you lift the levels of income, you find that the benefits accrue largely to the middle and lower income areas because labor gets the bulk of any increase in GDP. So that's the review of last week. But right now I want to talk about 3 new concepts we'll be introducing today, and hope you'll watch for them as we go through the slides. First, taxes affect the economy by altering prices and incentives, not by giving people money to spend or taking it away. Our analysis is not based on the Keynesian give money and take money away basis, which is designed to perhaps get the economy out of a short-run recession. These are permanent changes for long-run structure of the code and for the growth of the economy over time. The tax elements that matter that we use are the marginal tax rates, and that's the effective marginal tax rates, which we'll get to in a moment. But effective marginal tax rates are what happens if you work an extra hour or build an extra machine, how much do you get to keep out of the returns after tax. It's not on the first machine that you buy, but on the last you're considering. It's not on the first hour that you work, but on the next hour you might consider working, that governs your decision as to whether to do more or do less. Now, marginal tax rates and incentives, this is the second key concept. Marginal tax rates and incentives are determined by 2 factors, the tax rate and the tax base. And both are important, but the tax base matters at least as much as the statutory tax rates. And the third concept is changes in tax rates that alter incentives alter GDP. If you have a tax change that doesn't alter incentives, nothing much happens. You may move money around, but you haven't actually done anything fundamental to the economy. So tax changes that alter incentives change GDP, they change employment, and they change incomes. Knowing these dynamics improves the estimates of the revenue and budget consequences of a tax or spending change. It leads to a better understanding of what the tax or spending change is going to do to your constituents in their real lives, and it can help Congress design a better tax system and a better tax reform. So getting on to our next slide, this is your typical supply and demand curve situation. Anytime you have a good that you're considering, You have a supply curve that rises with the price. More can be produced at a higher price. How many of you remember what the area under the supply curve represents? These are the resources needed to produce each additional unit of the output. The more you have to produce, the more you're straining your resource base. That's why it rises. So these are the resources down here. This is the demand curve, and here we have a consumer who is going to buy less of something if the price is high and more of something if the price goes down. What's the area under the consumer demand curve? It's the value that the consumers place on each additional unit of output. So if you're up here, when the price is high, higher than the cost, what's happening? The supplier is taking, let's say, $80 worth of resources and turning them into $100 worth of consumer goods that the consumers value at $120. So you've got a $40 add-on in value, taking the resources and using it for this purpose. This value added is a measure of the good done by taking those resources and using them in this use. And this continues out until you get a price driven down to the point of equilibrium here where the two curves cross, where the consumers are just valuing the product at its resource cost. You wouldn't want to go any further. You'd be value subtracting instead of value adding. And this is what sets the price and the quantity in the market. I think you've all seen this before. Am I correct? Yes. Okay. So here we'll add a tax. The tax is the vertical distance between the top and bottom of that gray rectangle. That's the tax per unit. When you put a tax on, the cost to the consumer is driven up to this new equilibrium level. It's as if we have shifted the supply curve all the way up to here. And the producer is only getting this much down here. And the tax has driven a wedge between the two prices. Oops. The tax collected is the rate times the quantity, and that's the area of the rectangle. When you reduce the quantity, you're moving up the consumer's demand curve and down the producer's supply curve, and you're left with this triangle. And what do we call that? That is the deadweight loss. The consumer is giving up more satisfaction than the resources saved underneath the supply curve. So we're giving up potential value added here. The deadweight loss is inherent in almost all taxes, unless they're lump sum. Now, because of the deadweight losses, it costs the country more than $1 to buy an added dollar of government goods and services, about $2 more, actually. The notepad your bosses write on when they're sitting behind me here on the table that cost $1 at the General Services Administration, it really costs the country about $3. So I hope they take good notes. Now, when you start raising the rate, that horizontal rectangle, for example, would be a low tax rate that reduces the quantity only a small amount. You raise a lot of revenue, but you haven't done too much to increase you don't have too much of a deadweight loss. That's that small triangle here. As you raise the rate, quantity falls, and the rate goes up. And in this case, we aren't too far along, so the rectangle here, the square, has a bigger area than the red rectangle, and you're actually raising revenue. But look at the size of this triangle. It's many times the size of this one. Why is that? The deadweight loss rises with the square of the tax rate. If you double the tax rate, you quadruple the deadweight loss. If you triple the tax rate, you have a deadweight loss 9 times higher. And if you raise the rate too much so that the quantity actually collapses an enormous amount, even with a high tax rate, you may get less revenue in the purple rectangle than in the pink square. Which leads us to the famous or infamous Laffer Curve, which states that if you have no tax rate, a zero tax rate, you get no revenue. As you raise the rate, revenues grow. At some point, as the economy begins to react adversely to the tax, you have more and more trouble raising revenue further. Eventually, if you go too far, you've depressed the economy more than you've raised the rate, and revenues actually start to fall until finally, in the far right, you have choked off all economic activity. We shouldn't put too much reliance on this curve as an excuse to cut taxes willy-nilly. Most tax cuts do cost money. Most tax increases do raise revenue. They do, however, have some collateral damage. There are a few, perhaps, that are over the hump on the Laffer curve where we would get more revenue if we lowered the rate. And we have modeled it and suggest that perhaps this applies to capital gains for two reasons. People can defer the gains if you tax them more heavily, but there is a growth impact of taxing capital more heavily. And between the two, it appears that tax anything above about 10% would lose revenue. The expensing and depreciation rules seem to be very powerful in their growth effect, and they may be over the hump, which is why the House tax bill proposal for expensing looks so interesting. And probably the estate tax, which we'll get into perhaps in more depth later, seems to have knocked business investment and small business activity down enough over the years to perhaps be losing money, particularly where you take into account the absolutely wasteful practice of hiring slews of accountants to try to avoid the tax. They could be doing useful work instead. Now, the optimal point is not the peak of revenue maximization. You are having a situation where the tax is doing so much damage to the GDP at that point that you can't raise the revenue. Now, you have to take account of the revenue loss as well as the tax revenue when you're dealing with the private sector, because they're paying both penalties. They're losing income and they're paying tax. The optimal point is maybe down by the green, where the value of the added federal spending funded by the tax is big enough to offset both the tax cost and the lost income. Now, joint tax, CBO, and Treasury routinely adjust revenue estimates for the excise effects, and by that I mean the quantity effects of excise taxes. If they raise the cigarette tax, they assume there'll be fewer cigarettes sold. So they adjust the revenue estimate for both the rate change and the quantity change. But excise effects also occur for broader taxes like the income tax, the payroll tax, the corporate tax, and so on. And their effects on the size of the tax base are normally ignored in the static scoring of tax bills. Now, more recently, the House rules have suggested that if the tax effect is going to be very large, they want CBO and joint tax to try to do a so-called dynamic revenue estimate where they give an estimate of the GDP effects. These aren't used for official scoring, but they do guide the committee as to what they think the revenue effects might actually be after the adjustments occur. And that's useful additional information. Now, the importance of this is, of course, you really do want to know what the tax bill is going to do to your constituents. And if you don't do the dynamic estimation, you're not going to know that. So the dynamic estimation can help you design a better bill. JCT and CBO do point out frequently that they do make these effects for the excise taxes. So they claim to be microdynamic, but not macrodynamic. Various inputs and various activities are more or less sensitive to taxation. There's a concept in tax theory called Ramsey efficiency. If taxing something is going to make it collapse, you should only tax it lightly. If taxing something is not going to have much effect on it, you can put the rate much higher and still get your revenue without doing too much damage to the mix of output in the economy. Now, the rule of thumb here is that while both labor and capital respond to tax policy, capital is more sensitive to tax changes than labor. It's just a fact of life. Capital is more mobile. It can be sited here or abroad. Capital can move between countries more easily than populations. Investors can also choose to consume rather than invest. The capital simply might not be formed. And less capital means fewer jobs and lower wages. Wages grow with productivity. Productivity grows with capital formation. There is a very strong link over time between the rising incomes of the workforce over the last century or two and the great growth of technology and productivity that we have observed from the investment and research. Well, here's a picture of the tax on labor. You can see the supply and demand curve again, and you have your tax calculation here, the blue box. You can see that this is showing a very small increase in the cost of labor to the employer. The labor supply is only slightly elastic, not zero, but it is somewhat elastic, but not as much as capital. It's steeply sloping, and so most of the tax is shifted back to the workforce. When an economist tells you that labor bears the burden of the payroll tax, this is what they mean. You may have legislated it that the employer and the employee calculate a 50-50 share on it, and the employer takes it out of the wage bill and sends it into the Treasury. But in reality, the markets make it work this way, and the workforce bears most of the burden of the tax. There's also very little drop in the labor force, and you haven't done too much damage to the GDP. Like it or not, this is a fairly efficient tax. Marginal tax rates on wages, and this is on income in general, but the wage pattern shows a similar move. Marginal taxes on individuals, on the income tax and wages, rose sharply in the 1970s. Why? We kept cutting taxes almost every year in the 70s, but the tax rates rose. What happened? This was inflation. This was before tax indexing. Hill staff, including myself, worked very hard to get indexing into the tax system. We got it in '81. But for the 70s, people were rising up 2 and 3 and 4 tax brackets in the matter of a few years because of double-digit inflation. Working an extra hour ceased to pay very much. Workers resisted overtime. You had massive strikes at Ford, and I think Caterpillar, it was either that or Deere. Labor management relations in the 70s were just terrible. The workforce funded had to ask for an 11.5% wage hike to keep up with 10% inflation. And since the prices were only rising 10%, businesses couldn't pay it. And the government was basically saying, let's you and him fight. And Washington was taking in quite a bit of money, and they gave some of it back by increasing the personal exemption and the standard deduction, but they didn't lower the rates very much. So people were still 2 or 3 or 4% tax brackets higher up, and they didn't pay to take overtime. The 81 Act lowered it, and the 86 Act lowered it more. It drifted up a bit in the 90s because of real growth more than for inflation, because real growth will push you up through the brackets too. And then it came down with the recession in 2001, and then with the rate cuts. And they've been more or less flat with a little uptick recently. Now, this wedge is important because that graph showed you that when you increase or decrease that tax wedge on labor, you get some changes in the quantity of employment. And this is the graph on capital. Capital is much more sensitive to tax. We found over time, and we'll see this in some work next week, the capital stock over the decades, and back maybe 100 years and maybe even 200 years in Britain, you can find tax returns that are about a certain level pre-tax, but when the income taxes started to come in and where they roughly are now, you're getting after-tax returns of about 3.5% after taxes and inflation. And every time we shock the system and take you away from that, investment tends to respond either by, if the return went up, expanding the capital stock to drive it back down to around 3%, or if the tax rate went up and returns went down, you get a slower investment path until the rates are driven back up by the relative scarcity of the capital, and the returns come back up to about 3%. So I've shown a horizontal net return line here with the tax built on top of it, and the taxes primarily shifted upward toward ultimately the consumer and the workforce. And why is that? Well, if you have less capital, what happens to labor productivity? Obviously, it goes down. Now, this demand for labor curve, the red and blue lines, are in fact the marginal product of labor, given the various levels of the capital stock. And as you hire more workers, the marginal product goes down. So if you reduce the capital stock, the demand for labor drops, the wage drops, and employment drops. And this is why these days we talk about a large portion of the taxes on capital being shifted to labor. There are different versions of that. CBO says it's like 1/3 shifted to labor, 2/3 on capital. The more open the economy, the heavier it goes onto the workforce, because if capital can leave the country, the workforce is hurt by it. And in an open economy, it's nearer 90 or 100% on labor as the capital simply disappears. And the workers bear the pain of the lower productivity, and there's no additional capital to be taxed. Well, you've heard all about models that try to add up all the spending in the economy, consumption plus investment plus government spending and exports minus imports and all of that, to get a level of GDP. Our model is driven by these wedges. We know where we started. We know what the tax rates at the margin on labor and capital are. And if you change them, we get changes in the wedges and changes in the quantity of labor and capital. And so we have changes in the cost of capital, alters the capital stock, changes in the cost of labor, alters the labor force. Labor and capital together go into a production function, and we get output. And as output changes, people move up and down through the tax brackets because their incomes have gone up or down, and the capital stock adjusts. And by the time the model gets through testing all of the possible paths that get you to the new equilibrium, we get an answer. A lot of people in economics are surprised that you can actually measure the changes in GDP this way and get a prediction out of it. They're so used to doing it through spending. But the spending side of it seldom asks, what did you do to the profitability of capital and how much more did you get? They just have a rule of thumb such as, well, if you cut business taxes, X% will be used for investment. But where does that stop? Where do you get finally to that new equilibrium in the capital stock? Otherwise, you're just drifting. This actually has tracked very nicely historically with the economic responses to taxes from Kennedy through the present day, which we have done, and some of that's on the website. We'll talk more about that later. Now, economic changes affect revenue. The broad effects on labor and capital taxes on the quantities, the excise effects, drive the economy and they drive our model. They also affect federal revenue by altering total output and income. These dynamic effects are important. And they may also have some of the micro effects that the revenue estimates do calculate even under static scoring, such as capital gains realizations. I'm going to show you a very dramatic situation that happened when the capital gains rate was changed dramatically. In the 1986 tax reform, we decided to treat capital gains as ordinary income. And this was announced in advance. Now, if you know that your capital gains rate is going up in 6 months, what do you do? What would you do? Sell. Take all your gains before the rate goes up. That's the spike in early '86. After the rate went up, people said, okay, now what? I'm not going to take my gains. And they didn't. And now CBO every year for the next 10 years said, well, this is going to bounce back. That was just the lock-in effect or whatever. And we're going to have a return to normal within 2 years. It didn't happen the first year. So the next report said, well, within 2 more years. And then that didn't happen, and on and on and on for the full decade until '97 when we cut the rate back to where it had been. And then boom. And then you hit the recession, and then another boom coming up later. But you see, it did have a dramatic effect, and it fooled the revenue estimators. And Treasury and CBO and others began doing all kinds of studies on how the realization was affected by the rate. And now they have a more elastic assumption as to what would happen if you change the rate. I'm not sure they've fully captured the fact that this tended to be permanent instead of temporary, but at least they show some effects now that they didn't before. So here we have it. Tax revenue equals the tax rate times the tax base. The economic effects vary according to the rates and according to how the base is defined and measured. They're not uniform. I showed you a graph last week about different effects from different tax cuts, but we'll get into that in more detail later. I just want you to keep that in mind. And of course, as you can see, the devil is in the details. Now, before we get into the big taxes and the big effects on labor and capital, there's a funny set of quirks you need to be aware of. The marginal tax rate in reality depends on a couple of things. It's, of course, the statutory marginal rate change. And if you have done something that makes the change in the tax base differ from $1 for dollar for dollar, if you start phasing in things that are to be lost as your income goes up, such as the earned income credit beyond a certain point, it's a phase out, or if you phase in certain incomes that you only tax above a certain threshold, you'll find that the true marginal rate is not the statutory rate. It's either above or below. Last week we mentioned the phase out of the personal exemption, adding about a point to the tax rate for every dependent, and the phase out of the standard deduction doing something likewise, which makes the top 39.6% rate something in the mid-40s, actually, if you have a family of 4, in the phase out range. When you're beyond the phase out range, you drop back to a more normal rate. Now, would we ever say to somebody, if your income goes up by $1, we want you to report $1.50 in taxable income? In fact, this is a lovely way to broaden the tax base and lower the rate. I can solve the budget problem and lower all the tax rates with the wave of my hand. Let's say you have a tax form that says, on line 1, put down your income. On line 2, multiply line 1 by 3, just for the heck of it. Now, on line 3, pay tax on line 2 at half the old rate. What have I done? I've raised revenue by 50%, and I've lowered the tax rate by 50%, but I've still raised the revenue by 50%. Have I really cut the tax rate at the margin? No. That's just fiction. So when you broaden the base, you have to be very careful not to throw something into it 2 or 3 times, because if you're double taxing something, the statutory rate and the marginal rate aren't truly the same. Well, again, back to my question, would we ever ask people, if you get an extra $1 of income, report $1.50 in tax? Would we ever do that? How many of you have grandparents? What do they get? Social Security benefits. When you go above certain thresholds, you have to start reporting 50 cents in tax. So, excuse me, you have to start reporting 50 cents in Social Security benefits as taxable income for every dollar you go above the threshold. So I earn an extra dollar of interest or pension income. I have to report $1.50 in extra taxable income, and the tax on that extra dollar of pension income is really higher than it looks. And these things can have rather dramatic effects. These are phase-outs, the phase-out of the EITC, the phase-in of the income as you go through higher tax brackets, the ending of the child credit, and a whole bunch of other things. This is a little out of date. The thresholds have been widened in some cases, but you get the point. The top tax rate in the lower middle income range can hit almost 47% if you happen to be taking advantage of all these provisions at the same time. And these are tax rates that are normally applied only to the rich. But in these phase-out ranges, you get these obstacles to earning additional income, because if you do, you lose so many benefits and credits, you're not coming out very well. You want to avoid that, I think. You should. Now, here's the Social Security situation. If you're in the 15 or 22% brackets, and you're reporting another 10-15% brackets, you're reporting another 50 cents per dollar, your tax rates are really 15% and 22.5%. If you're in the 85% phase-in range, your tax rates are really 18.5%, 27.5%, and you can get into the 25% bracket, and they get up to 46%. Now, these periods of overlap with the brackets can be small in some cases, and they're not. Not everyone is affected, and many people are beyond them because they've gotten half of their benefits fully subject to tax or 85% fully subject to tax, and they're dropping back down to ordinary tax rates. For the people in the phase-out ranges, it's not very pretty. This is particularly true if they are doing some work while they're getting Social Security benefits, because the payroll tax is involved, and so is the income tax, and you end up with tax rates that look more like this. In the 50% phase-in range, the 10% people are paying almost 30%, the 15% bracket people 37%. If you're in the top 85% range, the tax rates go from 33 to 42 to almost 60. And then we have that lovely earnings test. If you're below the normal retirement age, when you're losing 50 cents in benefits for every additional dollar you earn above a threshold. Now, you do get that back later when you really stop working, if you live long enough. But if you don't, these are the tax rates you're facing, and you can see in some cases they go over 90 and 100%. You're telling the most experienced people in the economy, please stop working. We don't want you in the labor force. And by the way, that's before state income taxes. So don't think I'm exaggerating. Okay, so getting the tax base rate is very important. The tax base can be even more important than the tax rates for certain types of taxes. Now, I'm going to show you that the income tax is heavily biased against saving and investment as compared to consumption uses of income, and that the overstatement of profits obviously discourages investment in the United States. So you earn $1, you pay your tax on it, and after you've earned the dollar and paid your tax on it, you can go to the grocery store or the movies or the clothing store or the auto dealership, and we probably won't bother you again at the federal level unless you buy tobacco or liquor or ammunition or archery equipment or talk too much on the telephone. Oh, and gasoline for the car. Mostly other than that, we don't have too many excise taxes, and we don't have a VAT here. So consumption is pretty much free and clear after you've paid your income tax. But if you put the money into the bank and get interest, we tax the interest. If you're buying a stream of interest, it's taxed as well as the principal. If you put it into corporate stock, corporate income is taxed. They do have deductions for costs. We'll see later they're incomplete. But there is some residual corporate tax on earnings, and then they pay out the dividend and the capital gain, and you get hit a second time. And if you have an amount left toward the end of your life that's really only about as much as it might cost to keep a married couple in an assisted living facility for 10 years, there will be the transfer taxes. So a saving can often be taxed up to 4 times, and consumption generally only about once. This violates Ramsey efficiency because we know saving and investment is more sensitive to tax than consumption, so we're kind of doing it backwards. This is what I meant when I said that the costs aren't fully recovered by business. When you depreciate an asset over time, you have a problem. $100 spent today on a machine that's claimed today in a small business, well, you get a deduction for the full 100. That's your cost. And the revenues aren't considered taxable until they exceed the full cost. But if you're a bigger firm and you're required to spread that cost out over 5 or 7 or 20 or 39 years, if it's a building, what happens to the value of money as it goes further and further and further in time? It drops. And so the present value of the write-off stream is less when it's depreciated than when it's expensed. And that means that you're not fully recovering your cost before the government starts claiming that your revenue stream is taxable income. This is a measure of that. The fine print is too fine to read here, but if you take a look at it on the website later, you'll see what's going on. This is a chart put together by Professor Devereux. In our model, we use a slightly smaller discount rate and get slightly smaller results. But what happens is it drives up the after-tax cost of plant and equipment, and that drives down the quantity. This is particularly true the longer the asset life. Buildings are hit very hard, and if there's inflation, this gets worse, because it's not just the real return on capital, it's also the inflated return that gets driven down. And it can lead to some very unpleasant situations. In the 1970s, when we had 2 bouts of double-digit inflation, I was at a breakfast with Charles Schultz on the panel. He was CEA chairman, and we had some representatives of industry. And I asked a question at that point, because I was involved with tax indexing on the individual side, and I asked Mr. Schultz, should we also be indexing depreciation allowances for inflation? There are some firms that are reporting taxable profits that are in fact losing money. And he said, theoretically, yes, but we have a budget deficit and we haven't endorsed it, but theoretically it's correct. And one of the industry people who was the head of a Northeast utility said, oh, I don't want to do replacement cost accounting. I don't want to boost the depreciation allowances for inflation. And the head of a steel company said, why not? And he said, if our shareholders ever found out that we're really losing money, they'd have my head on a platter. And the steel executive turned to him and said, and exactly what has happened to your share price over the last 18 months? Well, it had tanked because stock analysts and brokers and ordinary shareholders knew perfectly well that the reported numbers in the annual report were all based on stable prices and not adjusted for inflation. And people analyzed this, report on it, and he wasn't fooling anybody. And investment in that period did not keep up with the growth of the labor force. And what did that do to productivity? Dropped it. And what happened to real wages after taxes in the late 70s? Downward. Okay, so if you want to have a tax system that equalizes the treatment of consumption and saving and investment, you need to take some steps. You need to expense investment, not just for machines and not just temporarily, but permanently, and buildings. And there are other ways of dealing with it. You could pay interest in effect or index for inflation plus a little real return on the depreciation allowances if you wanted to keep them. But moving to immediate expensing was one way to solve that cost accounting problem. Then you need to make saving either tax deferred or returns exempt. In other words, you need to give all saving the same treatment that we give IRAs or pensions, either Roth or regular. Because that second layer of tax on the saving after you paid tax on the principal goes away. The third thing to need to do is to integrate the corporate tax with the owner's tax. You can't tax the income at the corporate level and at the ownership the shareholder level. You have to tax one or the other, but not both. And if you're going to tax it at the shareholder level, you have to make sure they get to use the depreciation write-offs. Otherwise, they're lost. Not completely, because if the firm doesn't have to pay the corporate tax, it can keep the money and eventually pay it later to the owners, but you got to think about it. Finally, you need to end the estate and gift tax, which is a third or a fourth layer of tax, depending on what you had invested in as the money grew. Now, not everybody wants to have a neutral tax. One of the purposes of having the added layers of tax on capital was to aid in the redistribution of wealth. And that was also one of the reasons for the graduated tax rates. This was defended in the 1940s by Professor Henry Simons, who wanted to redistribute wealth because he considered the distribution of wealth to be, quote, evil or unlovely, close quotes. And that would be the rationale for having graduated tax rates and an income tax base. But even for him, the double taxation of the corporate sector was too much. So he wanted to get rid of that and tax everything else at graduated rates. Professor Marshall, who's a great British economist, said, well, you can have a progressive consumption tax where you're not double taxing the capital, and you can still make it progressive and you won't do as much damage to saving and investment. Even Simons realized that taxing capital multiple times would reduce the quantity of saving in the economy, reduce the quantity of capital, and lower wages, and he didn't want that, so he found what he thought was a solution. Suppose the government perpetually ran huge surpluses, bought back all its debt, and started pushing more money into the credit markets by buying up corporate stock and helping people invest to replace the saving that went away because of the graduated rates. This does lead to government control of industry, which has not worked well in Argentina, Chile, Cuba, and Venezuela. But at least you are supposedly replacing the lost savings. There are two problems, of course. When was the last time we ran a surplus and how long did it last? You know the answer to that as well as I do. And second, if you do put these higher tax rates on, you still get those wedges and you still have less total capital formation. Because if the capital itself is not profitable, even if the government's offering saving very cheaply, you're not going to borrow it because the return's zero. It'll go overseas. Private saving would go overseas and the government would take over the saving here. Wouldn't work. Well, we have a hybrid tax system. We have some pensions that allow partial removal of the double tax on saving. The top line here is a tax-deferred savings account. Think of it as a regular IRA. And I've shown this with a 7.2% interest rate with $1,000 a year saved until you're age 70. You end up, after paying the tax on the withdrawal, with about $400,000. But if it's subject to ordinary treatment, that is, we tax the $1,000 before you put it into the account, and we tax the interest, which knocks the rate down, you end up with about $240-some thousand. At age 70, we've taken away 3/8, almost 40%. Of your potential return. Now, this does reduce total saving in the economy, except for that part that can be covered by the various types of pensions. If you gave all saving this treatment, of course, you would get more saving total. These are the combined rates for the corporate entity and the shareholder, if the shareholder is in various tax brackets. If you're in the 15% bracket, your qualified dividends get a 0 tax rate on capital gains and dividends. But if you're in the 25 or so bracket, you start getting a 15% rate. And if you're in a higher bracket, 20, and then ultimately 23.8 with that tax that was put on under Obamacare to get the extra revenue from investment income to aid in the Medicare trust fund, which previously the tax had not fallen on investment income. The rates there, it's hard to see, but the basic rate is 35% at the corporate level, and if you're in something above the 15% bracket, it's almost 45, and the combined rate goes to 48 when you're paying 20% tax, and almost 51 if you're in the top bracket. Now, that means you're paying the income tax on the amount of money that the corporation may give you after it's already taken the 35% out. So this is the added personal tax rate on the 65 cents that's left over. And that's what you get. It's rather surprising. It's rather high. This is the estate tax. Now, we have on the left the top estate tax rate of 40%. The next chart, the IRS does not like to offend people. It doesn't want anyone to feel left out. So if you give your estate to your grandchildren instead of to your children, they make you pretend to have paid an estate tax to your children on their grant, and then charge you another estate tax on the remainder when they give it to the grandchildren in the generation skipping tax. And that brings the rate up to 64%. So everybody's happy. And now if that's on investment income, the third bar is on investment income, on a pension or interest you might earn, because you're also paying the state and federal income taxes on the interest before it goes into your estate, and that's 77% cumulative tax. And if you're earning wage income and you're self-employed, in this case, the added payroll tax is shown, and that drives the cumulative tax at the estate level to almost 82%. With taxes like that, every time a family business grows over a generation and you smack them with this, you knock it back down almost to where it started, and then it grows another generation and you smack it down again. It's sort of like whack-a-mole. You can't really grow with this going on. That obviously discourages capital formation. Now, we have the pensions, which partly offset the double tax on saving. We have the reduced rate on capital gains and dividends, which partly reduces the double tax on the corporate sector. And we do have an exempt amount on the estate tax. But the marginals are as I have shown you. So we are kind of a hybrid. We have some features of the tax system that don't have these added layers of tax, and some features that do. We're kind of in between a pure income tax and a pure saving consumption neutral tax or cash flow tax. If you want to read up on these differences, the Bush tax panel of the mid-90s looked at three taxes: a really pure income tax, a sort of prettier hybrid without so many loopholes and lower rates and faster depreciation, and then they did a complete cash flow tax that took out all of these problems. And you could read that. Now, the animation's not turned on. I'm sorry. That pendulum is supposed to be swinging back and forth there. We seem to move in various tax reforms more toward a pure income tax or more away from it. The Kennedy cuts, as we'll see later, reduced some of the tax biases against saving by altering the depreciation rates and lowering the corporate tax rate and the personal tax rate. The Johnson surtax in the Vietnam War kind of pushed us back toward an income tax. It was a very choppy situation in the 1970s where we kept sort of bouncing around. And then the 1981 cut moved us back toward in the direction of the neutral tax by accelerating depreciation and enlarging the investment tax credit and cutting the capital gains tax. And the 86 Act pushed us way back toward the income tax by treating capital gains as ordinary income and lengthening asset lives. And then we had the fill-up with the capital gains business that got undone later in the 90s. So we kept bouncing back and forth and back and forth. Why does it matter? When we have moved toward a neutral tax with lower rates, the economy has boomed. 62, Kennedy; 64, Kennedy, enacted under Johnson; 81, and 2003. 2001 was not as good as the 2003 cut, so distinguish between them. When we have increased tax biases, the economy has faltered. 69 was a bad year, the Johnson surtax. And 1986, as much as people pretend to admire it, if you look at it and ask the business community, they say it really followed up the international tax sector, and you did lower the corporate rate, but the longer asset lives and the repeal of the investment tax credit did more harm than the lower rate did good. You actually raised the cost of capital, and investment faltered a couple of years later, and we ended up in the next recession. And when we just have handouts that have nothing to do with saving, investment, or work effort, that are just giveaways to certain favored people, nothing much has happened. And we saw that with the rebates under Ford, continued under Carter, and then we had the 2001 Act, which postponed the rate reduction so long that you got virtually nothing the first year. And then there was the rebate-ish kind of thing that happened in 2009. So that's boom, bust, and goose egg. So if you want to go all the way to a neutral system, academics in the past have come up with some. And we have the national sales tax, or VAT. You have a flat tax, which was pushed by Representative Army, which is a returns exempt tax. You don't pay tax at the individual level. It's all collected at the business. David Bradford has his X tax, and a variation of that was put in under the old USA, under the current USA tax. The personal expenditure tax, which is my favorite, you put down your income on line 1, subtract your saving on line 2, and pay tax on the difference. That's consumption. And you can have that as a flat rate, which would be nice, or you can have the non-Domenici variation of that, which does the same thing but has graduated rates. So it's all kinds of ways of doing things. We think that the blueprint was kind of sort of take on the Bradford tax, and that was kind of the middle variant in the old Bush panel. It seems to be a lot of the characteristics of it. We'll get into the details in the future. Some of them were done well, some of them could be improved a bit. Well, the bottom line is, for the same revenue, an income tax depresses GDP and wages more than a neutral tax. Either can be made progressive. Again, Simons wanted the income tax because it's more progressive, and Alfred Marshall wanted a progressive consumption tax because it didn't have the collateral damage. And you can make either as progressive as you like, really, if you design them carefully. And stay tuned for details over the next 4 weeks, when you'll be able to get in there and tell us what you want to do and try and pick provisions, and we can try and sort them out for you and see how they might fit together. I hope there are some questions. I can't possibly not have confused somebody, but the floor is open for debate, or you can have another sandwich.